Welcome everyone to our Merlin AI preview. I'm really excited to tell you about this. A lot of interesting stuff inside that we've been working hard at. Prudent investing just got simpler and safer. As you can tell, I had a little bit extra fun with this intro here. And my favorite Robbie robot from Forbidden Planet and If You Only Had a Brain from Wizard of Oz. Tonight we're going to look under the hood of what's been developing. So it's going to be a little bit on the technical side. But that's the point, to give the techies a little preview of what's coming along. And eventually we'll talk more about what will really be deployed on SectorSurfer, AlphaDroid, and eventually as a set of ETFs. During the webinar, please use the chat feature available from the menu up at the top of your screen to ask questions, and I'll review them at the end. So let's get started. Today we'll review what is artificial intelligence, how will some growth use AI, how our genetic algorithm works. We'll take a look at the Genetic Momentum Portfolio Manager, that's the key software, look at experimental results and see what lies ahead, and ask why are AI funds missing in action on Wall Street? And finally, when and how will Merlin AI go live? I'll also make note that a video recording of this webinar will be available on the SectorSurfer page and the About Us Publications tabs down the center column. And on AlphaDroid, there's also a publications page that you see on the menu there. There will be a lot of technical information that is referred to in this webinar that we won't go to in depth. So if you don't have that background already, please know that you can go to the SectorSurfer homepage or on AlphaDroid and download a free PDF copy of the book. So what is artificial intelligence? This AI definition comes from Wikipedia, where it says, artificial intelligence is the ability of a machine to perceive its environment and take action to maximize its chance of success at some goal. So what does that mean for investments? It means, can a machine perceive its environment, such as there's a sector rotation thing going on in the market, or maybe you're changing from a bull to bear markets, and then take action to maximize returns and minimize risk? And we say, yes. How has artificial intelligence changed? Well, it seems that as machines have become increasingly smarter, what we once characterized as artificial intelligence, such as optical character recognition, is no longer perceived is good enough to be classified as artificial intelligence. At present, we use the term for understanding human speech, strategic game systems, self-driving cars, and interpreting complex data. Well, good thing. Financial markets are complex data. AI technologies include machine learning, neural networks, deep learning, adaptive algorithms, fuzzy logic, genetic algorithms, and a whole lot more. In this diagram, a very simple neural network is shown. Lots of inputs come in from one signal source or another, and they feed into many nodes or neurons at multiple levels in between that are cross-connected. And during a process of evaluating lots of kinds of data, these interconnections are strengthened or weakened, and the result is that you can have multiple inputs that then stimulate outputs to more or less degree, which is actually making a decision. As I suggested, there are lots and lots of types of machine learning algorithms. This is a list out of Wikipedia that's maybe half of the listing they have. It just goes on and on. But what's important is what we're going to use here. So again, AI is to perceive the environment and take action to maximize success. It turns out we already have two kinds of artificial intelligence within SectorSurfer and AlphaDroid. The first kind we refer to as forward walk regressive tuning. And what it does is adaptively change the algorithm based on past character of the data so that it walks through out-of-sample data for its buy and sell decisions. Also, we have StormGuard Armor, which employs fuzzy logic to evaluate a composite of 12 measures of the market's character to determine current investment safety. But what's new here is Merlin AI, and I've been starting to call this forward walk progressive picking, meaning that it uses a genetic algorithm to evolve the candidate funds in a population of momentum strategies to eradicate remnants of hindsight selection bias. Now that's a lot of big words. Let's go see what it means. In a typical SectorSurfer or AlphaDroid strategy, such as this Spider-Man Gold strategy, it often looks like perhaps the performance is too good and it must have a problem with selection bias. And what selection bias means is that although you may have done everything else right, such as our forward walk progressive tuning that walks through out-of-sample data properly, the question remains, when did you pick the funds? And if you picked them today, then perhaps you picked them knowing that your selection of funds did well. You wouldn't put any funds in there that did terrible over the last 20 years, so you probably picked funds that did well, and that biases the performance of your strategy. One way to show that this is not a problem is exemplified by this particular strategy. This strategy has all 9 of the original Spider ETFs introduced in late 1998 or 1999. And each of those sectors were designed to match what economists for decades and decades had defined as the primary sectors of the economy. So they probably chose those to make sure that they didn't get criticism that they didn't cover all of the economy or improperly represented sectors. So they just took what the academic circle said what the sectors were. So in this strategy then, we have all of those, such as you can see here, XLK, the technology, consumer discretionary, energy, healthcare, all of these guys in here. And since we have 12 candidate positions within a SectorSurfer or AlphaDroid strategy, then there's a few more things in here that are also put in, like gold and home builders. So in this case, not only do we have all of the sectors, but we also have some other cuts at some sectors. So if you include everything, then you cannot be accused of excluding something. So including everything is a method to overcome the criticism of hindsight selection bias. This strategy employs all sectors. Unfortunately, this leaves you to just these sectors to make a strategy. And fortunately, or unfortunately as the case may be, each of these sectors, such as healthcare, have been subdividing. Now there's healthcare equipment, there's biotechnology, there's pharmaceuticals, and there's healthcare services. Each of these main sectors has now been subdivided. So if each of them just had subdivisions to a factor of 4, now you have way too many. You've got 36 or 48 subsectors, which are way too many to be represented in a strategy here. But there is a way to deal with that, and that is what we call the strategy of strategies. So in this strategy of strategies, the individual ETFs are replaced by multiple underlying strategies. Each of these underlying strategies themselves have 12 underlying ETFs. So by this method, you can now make many, many strategies and include all those subsectors. And in a strategy of strategies, then you will own the best trending ETF in the best trending strategy, which is what you can see here. With so many underlying ETFs for a dozen strategies, one can employ pretty much all of the subsectors. So a strategy of strategies provides a methodology by which hindsight selection bias can be taken care of. However, that requires investors carefully make sure all of these subsectors are reasonably represented. And of course, that doesn't quite satisfy the critics. So there's a third method, and that is the method of Merlyn AI, which employs a genetic algorithm with forward walk progressive picking, which eradicates the remnants of hindsight selection bias. This is the point. By doing so, you have funds picked with in-sample data, but used with out-of-sample data. Thus, the hindsight selection bias has been removed. This is the whole purpose of Merlyn AI. Merlyn AI builds on and does not have to rediscover other existing knowledge. For example, it doesn't have to reinvent all of SectorSurfer and AlphaDroid from scratch. That means, for example, Merlyn AI accepts that momentum has already been discovered. It accepts that it's been confirmed. It accepts there is signal-to-noise ratio theory. Doesn't have to rediscover this. The solutions that signal-to-noise ratio theory uses to reduce the noise, such as matched filter theory, are accepted. Differential signal processing is accepted. The fact that sectors do rotate and provide power strokes is accepted. Storm guard armor is accepted. So what Merlyn AI really is a genetic algorithm layered on top of our strategy technology used in AlphaDroid and SectorSurfer, with a purpose to evolve the candidate set of 12 funds each month in order to eliminate the remnant fund hindsight selection bias. And what this means is that selecting the set of 12 candidate funds is now automated, and it means we must relinquish control to a higher power, that being Merlyn AI. Fund selection has now become automated. So let's take a look under the hood. While this might be too many details for some people, others really do want to know what's in the black box. So let's take a look. Consider this analogy to humans. Humans have hands, feet, arms, heads, etc., different body parts. And when we do have genetic evolution, it comes in two forms. One through mutation, such as when that cosmic ray comes in and zaps one of the genes, makes it a little bit different, or through crossover. Beings exchange genes and produce an offspring child. So in any case, some change occurs. And when it occurs, then the different body parts don't interchange. For example, you don't end up with a left foot showing up where your arm is. You get a bigger arm or a stronger arm, smaller arm, different colored arm, something. But it's always an arm. Merlyn AI will work similarly with a strategy. So consider that we have different sectors in the market, and when we mutate or do crossover with our strategy, we don't want to eliminate energy or materials or something like this. There are multiple kinds of energy funds and healthcare funds, and so we just want to try different things and have always a full set of body parts by swapping in and out different ETFs within the same sector. To be a little more clear on how this works, this spreadsheet shows the definition of a genetic algorithm strategy. It has many of the things you would expect in it for a regular SectorSurfer or AlphaDroid strategy, including specifying that it's going to use Storm Guard Armor, Bear Market Strategy A, Trade Month End, etc., etc. But down here I want to point out that there are 12 different rows here. Instead of the normal specifying one ETF for each of the 12 candidates, it specifies a range of ETFs. So for example, for energy, this part of the strategy, row 15 lists all of the major energy ETFs. In row 16, we have all of the major financial ETFs. And so as we do mutations and crossovers, these are the ones that it can possibly select between. There isn't going to be mixing between industrials and energy or any of these others. One might reasonably ask, where did the list of all of these ETFs come from? Well, they simply came from scraping them off of the ETF.com site, where you can sort ETFs by many criteria, including sectors and many other things. And in this case, I then resorted them by assets under management, and then selected the ones that were for US ETFs, US markets, and excluded the ones that were for foreign markets, and excluded ones that were too small and might represent a problem with ordinary trading. So, how does a genetic algorithm work? Well, consider a normal population of people, here a population of 12. And each month, mutant and crossover children are made. So these children have a little different legs and arms and heads and are a little bit different than their parents. Going forward, we're going to maintain a population of 12, but only children with better fitness than their parents survive by replacing the parent. So if a measure of fitness says that the child is going to be better than the parent, then the child replaces the parent and the parent dies. Otherwise, the child does not survive to go on. And in this way, we have the opportunity to upgrade the population little by little over time. The measure of fitness is important, and in this case, it ends up being not strength or ability to eat food fast or whatever you might think would be important for animal populations. In this case, we want ones that have higher returns and lower risk to survive. So a combination of higher returns and lower risk is used to determine fitness and survival into the future. Let's take a look and see how this plays out for one of the 12 members in the strategy. In this particular member, we see across the top symbols 1 through 12. Starting in 2006, it had these particular ETFs filling those positions. And as you can see, as time goes on, then the ETFs in these change. Not only are they allowed to change from one ETF to another as time goes on, but they can even be turned back into a blank. Maybe the whole category of energy becomes unsuitable, and so it's better not to have any energy representative at all at that time. In column B, we see references to things like M1 or C1. The ones that are M's are indicating that there was a mutation that caused this change, and the ones with C are indicating there was a crossover. So this is the evolutionary history for member 1. If we look, for example, at member 6, you can see it says member 6 over here, we see the list is a little different. Now I'm going to switch it back and forth between the two, and you can see each of these has evolved differently. While there may be some similarities in holdings, there are differences. And it is actually important to have members evolve slightly different from one another, as I'll explain shortly. One further concept that's important here is that this is going to be a portfolio of such strategies. As illustrated in this prudent 80-20 portfolio, there are multiple strategies. One for bonds, a style box type that's like large cap, small cap, value, and growth, a sectors strategy, and a global strategy. And when plotted on a risk-return chart, they take up this various set of positions. The portfolio basically takes advantage of traditional diversification, where the portfolio enjoys approximately the average of the returns. However, risk is reduced approximately by the square root of the number of participating divergent strategies. And these are divergent because bonds are not like indices, which are not like sectors, which are not like international funds. So there are minor wiggles and gyrations in the equity curves of these different strategies, results in a lot of the noise cancellation and producing much lower risk, as you see here, by the portfolio location. With that, let's now fully go under the hood and take a look at the Genetic Momentum Portfolio Manager application. Now this is really down in the bowels of the engine, and I just want to make a note that you don't have to be worried about ever having to operate this. So it's a peek down in the black box. Just briefly, the upper part has to do with saving and opening files and how to do an execution run. The next group has to do with a number of characteristics and parameters of how the portfolio is going to operate. Down here, you see a listing of strategies that are part of the portfolio, and you can see some SectorSurfer, AlphaDroid kind of like parameters over here. Here are the members under here, nothing filled in here right at the moment. And the whole bottom is dedicated to looking at the statistics as it develops over time. I have a little reminder to myself off on the right here to start Merlin running. So I'm going to start up the application, and we'll see the things starting along, and then we'll come back and I will describe a lot of the pieces of this, and occasionally we'll check in and see how Merlin is running. Okay, let's start up Merlin. And Merlin asks us, do we want to load the same portfolio we've been working with? Yes, we do. Now it's loading up all of the necessary funds in the portfolio into cache memory. It says we've loaded it just fine. And this particular portfolio consists of 4 underlying strategies. They're a little different from one another, and they've run before, so they have charts and data below. We're going to work with strategy number 1 here for this demonstration. It has only had a run through 3 years. Up here in the execution control, I can set any amount of time or incremental run that I like. So we're going to run all years from start. I'm going to just quickly check through, make sure all of these things are where I want them. I'll explain them in more detail in a moment. And strategy 1 here is a typical sector rotation strategy. It will use those exact set of funds that you saw earlier. It's going to use StormGuard Armor, Bear Market Strategy A, Trade Month End, and some other little things in here. And I think we're ready to go. So I'll click the Start button. It starts with each member strategy with SPY as its only fund. And as we go along here, we are doing mutations of each of these. It gets 12 mutations, and it tries to put ETFs in those other positions that are qualified. As you can see, we've gone past January. We're now executing on February. We first do a set of mutations across the way, and then you'll see it turn blue, and it's doing crossovers. That was rather quick. And then it does a evaluation for the new month, goes through a set of mutations again, comes through with a set of crossover as after that. Again, that was rather quick. Apparently there wasn't much to do. As we start executing along in time here, we can start to see plots coming along of the performance of the strategy in the S&P 500. Up here you can see the rolling return and the rolling drawdown forming. Eventually, when we get to a year or so, some of this other data can then be calculated, and that will fill in. But for now, let's go back and I will show you on other screens what some of these things are. Back to our Portfolio Manager tour. As indicated before, in this upper portion, it's mostly about file management. There's a file for each portfolio, and a portfolio contains a number of strategies. And so this particular portfolio, 60-wise-p.csv, has a definition of how it's going to operate, and in particular, how many strategies and their allocation weights. When we click this View Strategies button, it pops up this little screen, which actually shows us what the strategies are and gives us the ability to click and edit them. So if we click on one of these, then we get that same spreadsheet with the strategy definition that we saw much earlier, the one with all the list of the ETFs in it. Now in the center section, these boxes here contain options and information and controls for how the portfolio is going to operate. One of the things that a design engineer runs into when designing the software is you say, I'm going to run a genetic algorithm, but there's lots of questions, such as how many mutations per month should I do? How many crossovers per month? Because if you take a whole lot of them, then it takes a whole long time to run. But if you don't do enough, you might not evolve fast enough. Also are the questions of whether you should bother mutating one that you currently own. Maybe the philosophy of letting the winners run should hold. Turns out not to be true. Then there's the question of whether a random or sequential selection of mutant alternatives is the best. Turns out random is not good. It's what nature uses, but it might take you forever to get the right guy in there. Sequential turns out to be much better. We have a brain, we can do sequential. In the next group, this is all about mutant diversity, a very important concept that prevents all of these members from evolving into identical clones of one another. To help prevent that, we have a rule here that says there is a maximum number of copies of any particular ETF among all of the family members. In this case, it's 4. We can see here that ARKW, the one actually selected at this particular date, actually is displaying those 4 as the winners. But ARKW cannot be held in any other of the strategies. It must pick other things. And an excellent reason for that goes to the Black Plague. When it killed off about half of the population, well, the other half survived because they had some kind of recessive genes that helped them out. It's important to be ready for when the Black Plague comes. If your current set of genes only allow you to operate well today, then when the Black Plague comes, such as a market crash, you won't be ready. You need to have alternative genes within the population. Now checking back and seeing how Merlin is running, we see we're now up to September 30th, 2009. You can see the equity curve coming along. Looks like we have been through the market crash. You can see the S&P 500 crashing here and rebounding. During that period, BMSA, bear market strategy A, came into effect. This is an interesting little artifact here, which is a 2x leveraged 10-year treasury. I'll address this little bump in just a little bit. We're really forming up a pretty good rolling return chart here and a rolling drawdown chart. And we now have the beginnings of Sharpe ratios and Sortino ratios. The Sharpe and Sortino for the S&P 500 is still negative. Remember that it's offset by the return of a money market fund. So until it gets up to at least a money market fund, it's negative. And it looks like it has done that now. They're at 0. The risk and return measured in these boxes here is in the format of our partner Riskalyze. And there's two different risk calculations. One of them is relative risk that we use at some growth. So the relative risk of the S&P 500 at this point in time is 151, whereas it's only 66 for the strategy. As you may recall from the documentation, relative risk has to do with the quarterly downside deviation. Riskalyze, however, has a very similar but different measure called the risk number. So when I click that, then you see the risk of the S&P 500 is currently at 100, and the risk of the strategy is at 44. That was a nice little bump up. Found some good stuff to get. So let's return and examine a few more details of how this works, and then we'll come back in for another checkup. Next up is mutant suitability and mutant behavior. Both of these have to do with the character of an ETF. An interesting thing found when observing many runs is that there are interesting cases where an ETF, for one moment, is behaving well, and then next month starts behaving erratically, getting much more volatile, and perhaps even having a sharp drop. I've implemented some suitability tests, which I will describe to you momentarily, that are much in line with the same philosophy of StormGuard Armor. StormGuard Armor, as you may recall, has 3 different tests of the market and really determine whether it's safe to be in the market. Not whether the market is moving, but whether it's safe to be in the market. Well, a similar situation apparently is true with individual ETFs. There are times when a sector becomes unsuitable and we should just stay away from it. One of these particular characters has to do with volatility, and another has to do with what I call pop and drop. Pop and drop relates to a sector that suddenly runs up strongly and finds it has nowhere to go but flat or down. Once it has run up strongly, doesn't mean that it has great momentum, but it might be overbought. And so after an extraordinary pop, it's more than likely that it's not going up further. It's more likely that it's actually going to be flat or down. Along with the suitability and behavior characteristics, the question is whether to block it or try to mend it. And the answer to both of those is yes. This next block is for decisions relating to looking at the set of candidate alternatives for a particular sector. Should they be selected on a random basis, or should we say, let's take a look at the best trending ones first? And of course, the answer here is yes. Looking at the better trending ones is a better way to evolve other ETFs into a strategy. And finally, there's member fitness. How do we measure the fitness of a strategy? How do we know whether a mutant child is more fit than its parent to survive? There's any number of ways one can combine both risk and return. Turns out, among all of them I've tried, using the 5-year CAGR, the annualized return 5 years, divided by the square root of the relative risk, seems to be about the best. I want to take a moment to address the question of whether mutant suitability and mutant behavior tests fall in a classification of hindsight selection bias. And to do that, let's discuss the difference between a travel agent and an engineer regarding advice for Route 66. So one day in 1960, you head down Route 66 from Chicago to Los Angeles. And along the way, in your jalopy, you end up occasionally finding trouble with the road. Roads were not so good then. There were more potholes, and there were things on the road, and tires were not made so well, and often there were particular stretches that were very bad. So on the trip, you're doing a lot of tire repair. Eventually, of course, you come to the desert, and you find traveling across the desert during the day often causes your radiator to overheat, and there you are on the side of the road. Similarly, all the mountains you got to go up and down, more radiator trouble. Fortunately, you are successful and get to have your vacation in California and then head back home along the same route to Chicago. Then you tell your neighbor Joe about the great travel vacation you had. And he says, boy, oh boy, I'd really like to do that too. And if you're a travel agent, you say to him, oh, Joe, let me make a map for you and circle all the places on the map where I ran into hazardous roads. Also, there's some places where it would be good to stop for the night, but get up early and drive while the desert is still cool, and places where you can find water along the way while you're sipping that cool beer. And so travel agents provide a hindsight selection map. Repeated routes are better, but new routes are not, because there's no knowledge of where the road hazards are. The engineer, on the other hand, thinks about it and says, well, Joe, before you head out, let me fix up your car a little bit. And the engineer goes to work and designs some better tires. He decides to use neoprene rubber instead of natural rubber and put some steel belting in it to give it some strength. And then he goes to work on the radiator, makes it 50% larger and increases the airflow around it. And then goes to Joe and says, here, take this car. This car is suitable for the highways ahead. And so engineers provide better tires and radiator designs to better withstand any roads you choose. So Joe can go anywhere he wants. So this is the difference between a travel agent and an engineer and how they use data they get. The travel agent learns how to avoid it in hindsight, but the engineer learns how to do a better design. Doing a better design prepares you for the road hazards on any road in any order that they may occur. With that in mind, let's take a look at another thing that can help us improve our tool. So what is the suitability I was previously talking about? Well, it means suitable volatility for making a good decision. In this chart, the first row is the correlation between each of these ETFs and the MDY, the midcap. Obviously, the midcap would be 100% correlation. XLF, for example, is 82%, XLK, 85%. That's pretty well correlated. The worst correlation here, of course, is things like gold and bonds. How about standard deviation? This is how wiggly it is. This is 1.61%, 2%. Some of these are pushing 2.5%, while of course the bond has the lowest percentage volatility. Now, when we're making a relative decision between one ETF and another ETF, we look at the difference between them to make a decision. So what's the difference in the standard deviation between them? That's another set of numbers. And this next line here shows us the reduction in volatility that we get when we subtract one from another. And we find, for example, that bonds and gold actually have a negative decrease, which means they actually have increased volatility through doing a differential calculation, whereas the standard deviation reduction for XRT went from 1.61% to 0.91%, which is a 0.7% reduction. That's huge. So in the end, we can create a calculation, which I refer to as safe volatility. In the end, we can get a measure of volatility relative to the MDY that gives us an idea of whether or not it is safe to even look at these things. So remember Stormguard Armor's big revelation? It's about safety. While its trend may still be reasonable, if its character becomes erratic, you have to head for safety. Now in this spreadsheet, we see in the left-hand column dates. And I particularly want to make an example of biotechnology. Many of you may remember that in February of 2014, biotechnology took a huge dump. These values in this spreadsheet are the suitability calculations for these different ETFs, and the ones that are marked in orange are the ones that have negative values, which is the threshold for unsuitability. And as you can see here, biotechnology, XBI, and BBH to some degree are showing themselves as unsuitable during this period. In fact, when the dump occurred, which is right here, both of the biotech ETFs were unsuitable. However, the pharmaceuticals, XPH and PJP, were just fine. Some of you may be familiar with TAN, a solar energy ETF known for its wicked volatility, and it is also quite unsuitable during that period. XLB, the materials, and XLF and XLK are quite suitable during this period. I make mention of those to show you the next chart, so we can look at them in detail. On this chart, which spans 2 months before 2014 and about 8 months after 2014 started, we can see 3 funds up the middle which are fairly well behaved, which are XLF in blue, XLK in orange, and XLB in red. So materials, technology, and finance, which all had great suitability numbers, are doing just fine. However, XBI in light blue became quite wicked in the early part of 2014. Its relative volatility said it's too wicked. Similarly, TAN, the solar cell ETF, is also obviously quite wicked. XPH, the pharmaceutical, is a bit more volatile than these ETFs up here in the middle, but nothing like the others. And so you see, if it's not suitable, you should really just say no, because you're more likely to be hurt by a sharp pullback. These very volatile ETFs create horrendous whipsaw, and you're more likely to miss the upside and be caught on the downside. So just say no. And that is what suitability within Merlin does. Now back for another checkup, we see the equity curve for the strategy is going along pretty nicely. A couple more places where we've experienced StormGuard armor in orange along the way. Coming along pretty good. The rolling return, we like that curve because it stays healthfully above the S&P 500. Drawdown is much less. The risk return chart says we're in really good shape. Maybe about half the risk for 3 times return. Only 7.7 trades per year. A fantastic Sharpe ratio, Sortino ratio, an average return that's much better than the S&P 500. A risk, as measured by the Riskalyze risk number, that's only half the size of the S&P 500. Just 2 months to go, we'll have another checkup right at the end. Finally, although I mentioned it before, I'd like to reiterate that a genetic algorithm with 12 underlying member strategies must have a method to select its final ETF choice. In this case, we use the method we call the strategy of strategies. In other words, each of the buy symbols chosen by each of the members then become candidates for selection in another strategy. So in this case, ARKW, IHI, RYT, IGM, PTH, and ARKK all become candidates in another strategy. And the trend leader selected by that strategy then becomes the final ETF choice of this strategy within its overall portfolio. I thought you might be interested in this comparative view of 4 different runs with minor variations between the setups of the portfolios. In the upper left is the configuration of the portfolio we're running in the background right now. In the upper right is a variation that changed the number of monthly crossovers to 0. You can see that the crossover feature is apparently at least somewhat important. In the lower left, there was an attempt to try an experimental feature I called Bad Boy Remorse, which has to do with how do you recover from detecting a pop that might drop. Do you recover very soon or later? And as you can see, its performance is less than the best so far. The variation in the lower right attempts to try 4 mutations and 4 crossovers, and that also underperforms. The reason for this appears to be that excess evolution each month leads to more of these members being alike one another and less diversity. In any case, they all have almost identical risk, and their CAGR, their average returns, varies only from 25 to 28%. Even the worst of these would be hard to complain about. So why are AI funds missing in action on Wall Street? This listing from ETF.com shows all of the ETFs they categorize as being associated with artificial intelligence, but only 2 of them, AIEQ and AIIQ, are actually AI-powered. All of the others only invest in companies that use artificial intelligence or robotics, and both of them come from the same company. Equibot, and both of them use proprietary algorithms with IBM Watson at their back. Interestingly, AIEQ, plotted in black here, underperformed both the S&P 500 and the NASDAQ for its first 5 months, but now has surpassed the S&P 500. But still, IBM Watson is not sufficient to help them keep up with the NASDAQ. AAIQ, which just started in June of this year, seriously lags the S&P 500, but approximately matches the EFA index. Considering the moniker of IBM Watson, this is not impressive. But AI is having its problems in other markets as well. After 6 years and billions of dollars, the diagnosis that Watson can help cure cancer so far has not worked at all. And what about BlackRock? BlackRock just introduced 7 AI-powered sector ETFs. AI-powered? But what does that really mean? It means the firm is using machine learning to parse language in public filings to determine a company's weighting in a particular sector. Constituents will be rebalanced quarterly. So this isn't AI-powered picking of stocks or picking of ETFs. It's just helping refine the purity of what is in a sector. That's not going to help anybody's portfolio with either risk or return. In the end, it's a distinction without a difference. I think a lot of the problem has to do with most AI research being focused on neural network deep learning. In order for AI to help solve the investment problem, there are a lot of fundamental things it must do. For example, can it help discover the importance of signal-to-noise ratio? I don't think so. Can it discover matched filter theory to reduce the noise? Not likely. Can it discover differential signal processing to help reduce the noise? Not likely. Can it discover problem segmentation for bear markets? Don't think so. Can it discover temporal suitability tests for candidate funds? Not likely. There's just too many simultaneous problems to solve. I believe that's the root cause for why neural network deep learning apparently has been a failure for all of the big financial corporations. So far, it appears they've produced absolutely nothing. The primary reason Merlin AI works so well is it is not tasked with having to discover many things all at one time. It doesn't have to discover signal-to-noise ratio. At the same time, it has to discover matched filter theory, differential signal processing, problem segmentation for bear markets, and so on. It is built on proven knowledge and methods. And particularly, it focuses on one problem, and that's eliminating hindsight selection bias, a very important problem. So what lies ahead? In development, we have to complete a few algorithm tests and refinements. We have to create strategies for indices, world regions, bonds, etc. We have to complete the portfolio level charts and reports and create support documents and web pages. How about deployment? We believe that in September, we will deploy it to SectorSurfer in the form of a master strategy of strategies. In late September, we'll deploy it to AlphaDroid, also in the form of a master strategy of strategies. In late September, we also plan to start a new company that will launch the Merlyn AI ETFs, and in early October, we'll deploy it to the Riskalyze Partner Store page, similar to other portfolios. And if all goes well, perhaps in Christmas, Santa will deliver Merlin's first AI ETF. The run is now finally complete. It took 1 hour and 3 minutes to run. The last buy as of July 31st was PTH, and an annualized return for this strategy of 30.4%. Down here we can see the equity curve. The orange portions, of course, are where StormGuard Armor kicked in. A very nice thing on a 2-year rolling return chart is when the strategy always stays above the benchmark. In terms of risk, we had a Sharpe ratio of 2.1 versus 0.43 for the S&P 500, and a Sortino ratio of 14 versus 0.69. And then looking at these risk and return numbers, we see that the strategy had over 3 times the return of the S&P 500 and less than half the risk. Now that's something to write home to mom about.
Prudent investing just got simpler and safer. Merlin just gave me this awesome book of investment wisdom. It's obviously a must-read game changer. Are you ready? Great. Evolve and prosper.